I'm Nicholas Bornoz of Capital Inc., and I would like to welcome you to the ETF Industry Roundtable. This roundtable is being moderated by Mo Sparks, who is the Director of Exchange Traded Products at the New York Stock Exchange. I would like to take the opportunity to thank the New York Stock Exchange for their long-standing partnership and support of this event. We've been doing it together for, I think we have lost track how many years now, but this is the 22nd annual event, and thank you very much for your contribution. And I would let Mo introduce our panelists, who I would like to thank very much, Michael, Anthony, and Matthew. By the way, before I disappear, the participants are welcome to submit questions through the platform, and the questions will be answered by the panelists at the end of their discussion. And with that, Mo, the floor is yours. Thank you very much.
Excellent. And thank you, Nicholas. And obviously, thanks to everyone from Capital Links for the continued partnership. I agree. I think it has now been a number of years where we can't count, but look forward to many more to come as well. And then obviously, I'll allow actually my panelists to introduce themselves in just a moment. But Nick said, Mo Sparks, Director of Exchange Traded Products from the New York Stock Exchange. So we have the privilege of working with kind of everyone across the broader ETF ecosystem, as well as across the closed-end fund ecosystem. So unfortunately, not together today in person, but love an opportunity to just come together even digitally and discuss some of the things that are happening across the ETF industry. You know, those that don't live in it every single day probably don't just appreciate how quickly this market is growing. It was only earlier this year that we celebrated 2,000 ETFs listed at the New York Stock Exchange. And through the first quarter of this year, we've helped 80 unique issuers launch products, about 250 new ETFs coming to market. And so really our time together, although brief, about 40 minutes, will be spent on kind of talking through some of the trends that we're seeing across the market, and the things that we think are maybe on the horizon for this industry moving forward as well. And so I'm actually start with Tony Rochte from Morgan Stanley and allow him to briefly introduce himself and obviously the firm and his responsibilities. Go ahead, Tony.
Great. Thank you, Mo, and good afternoon. My name is Tony Rochte. I joined Morgan Stanley Investment Management almost 2 years ago to build out a global ETF multi-brand platform. Some of you may not be as familiar, but we acquired Eaton Vance over 3 years ago. And with that, that included the brand like Parametric, our customization engine, a leader in active fixed income in Eaton Vance, certainly Calvert, a leader in the ESG category, all under the Morgan Stanley Investment Management platform. So we're launching an ETF business off of that. We've launched Parametric, Eaton Vance, and certainly Calvert ETFs in the past 9 months. I've spent most of my career in the ETF space. I was one of the initial hires at iShares, worked on the initial plan for almost 6 months before we launched, and then spent about 7 years. I always say, Mo, I was there for the first quarter trillion. I co-led the Spider ETF business with Jim Ross, and was helped launch Fidelity's capability and spent almost 8 years at Fidelity. So thrilled to be here and look forward to talking about the trends.
Excellent. And thank you, Tony, obviously, for joining us. A wealth of knowledge and experience, and excited to talk a little bit more about what Morgan Stanley is up to. Maybe next, I'll allow Mike Venuto from Tidal to introduce himself and Tidal Financial.
Okay, thank you. Excited to be here. My name's Mike Venuto. I'm the co-founder and CIO of Tidal Financial Group. Most people know us as a white labeler. I think we do a little bit more than that. We think of ourselves as more of a platform. Today, we are servicing over 118 ETFs and over close, I got to be careful for compliance, over $9.5 billion in assets. I like to say close to 10 because it could be there, but got to thread that needle. So we help people launch and grow ETFs. We were just recognized in the industry by ETF Express as the best ETF platform. So if you want to launch an ETF, your first call should be Mo, and then your second call should be us.
Well, excellent. Well, thanks, Mike. So last but certainly not least, we have Matthew Schwark from State Street Global Advisors. So Matt, go ahead and introduce yourself.
Thank you, Mo. And good afternoon, all. And thank you to Nicholas and Capital Link for hosting us today. It's a pleasure to participate on this panel alongside Mo, Michael, and Tony. I'm Matt Schwark, and I'm a senior ETF capital markets specialist at Spider ETFs, a division of State Street Global Advisors. I joined Spider from Citadel nearly 6 years ago, and I sit within our firm's ETF capital markets team, where I lead our business development efforts with many of the largest market makers and APs on the street. A little about our firm. Spider currently has 138 ETFs in the US marketplace with a combined AUM of over $1 trillion. Our flagship ETF, SPY, was the first US listed ETF and has nearly $394 billion in assets under management. Thank you.
Perfect. Thanks, Matt. And so you can quickly see that we have proper representation kind of across the broader industry to have a really nice conversation around some of the things that are happening. And so, Tony, I'm actually going to start with you and then bring this to everyone kind of across the panel. One of the more foundational shifts that we've observed here from the NYSE vantage points and then across the broader industry is a shift towards active management, right? And so this year, basically 3 out of 4 ETFs that have come to market have actually been actively managed. If you rewind the clock, even 3 years ago, that number was as low as 30%. And so it's a pretty meaningful shift. So Tony, maybe talk to us about what do you think is driving that, and what are you observing within the active market today for ETFs?
Yeah, let me take a step back to maybe the why. There's a number of reasons why, but I think the one that many are familiar with is Rule 6011 enacted in the third, fourth quarter of 2019. That really enabled traditional active managers to enter the market without filing for the exemptive relief. It accelerated it to as short as 75 days for a traditional ETF filing. So I think the why, Mo, is a lot more traditional active managers globally have entered the market. I would say Europe looks different than the US. I think only roughly 2% of the European market, which is about 1.7 trillion, is active. But what we've even seen in the last 12 to 18 months is new traditional active organizations in Europe. In terms of the US, I think many are familiar, anywhere from 25 to 30% of net new flows into the US ETF market, which will finish over $500 billion this year, likely, in terms of net new flows into the category, have been active. If you look through that, what's even more interesting is 44% of the flows have gone into fixed income. So you've got this trend. It's not just active, it's active fixed income. It's primarily active transparent. And then the question, Mo, that everyone asks is, are they performing? We actually looked at Forbes, actually it was Barron's at the end of July. There were 230 fixed income ETFs that have been launched. 68% were actually outperforming their benchmark. So active ETFs are a trend, both equity and fixed. Some of it's regulatory driven, and we're seeing solid performance, particularly in the fixed income space. Do I think it's going to continue? I do. Yet, when you look at the flow, call it 25 to 30% of the US ETF flows, yet it's still somewhere between 5 and 6% of the AUM. So we've got a long way to go, but we've definitely seen an increase in ownership. And firms like Morgan Stanley Investment Management, at the center of our DNA is traditional active management. And that's why, we've launched 11 ETFs in 9 months, and the majority of them are actively managed.
Thanks, Tony, and appreciate the context of, what, if you do take the step back, what is starting to drive these things, right? And drive adoption and interest from end investors. Mike, maybe coming to you, right, as a white label, or as we talked about, a platform, right, to support issuers in that journey. What have you been observing, and what additional kind of comments would you bring into the conversation?
Yeah, so I'm going to continue the statistics that Anthony started with here. So almost everything that comes to us at this point is active. The rare occasion that we see something passive, it's usually because they want to dual list in Mexico or Europe where it's a lot harder to do active. So on a statistics point of view, right now there's about 430 billion in active ETFs, which is right about 6.2% of the overall AUM. What's interesting is, even though it's a tiny part of the AUM, and Tony hit on all the growths of it, it represents 15.1% of the revenue of the industry. So it's more than punching twice its weight there. Explains not only why we're seeing so many launches, but that's the incentive for actual businesses to get into this, right? Like and convert over. It's also punching over its weight in terms of actual funds out there. So out of the 3,322 ETFs as of today, 1,102 or 33% are active, right? So now we get to the part where we know why everybody's running here. Average ETF is 11 bips. If you go passive, average weighted for assets is 42, 4 times when you go active. So, the regulation opened the door for people to embrace this. The fear of transparency seems to have left. And as long as these managers are producing something valuable with their active management, I think the market is going to be very accepting of it, because 42 bips is still way lower than what you would be paying in less efficient vehicles that people have historically flowed to.
I think really useful in terms of the numbers. As you know,
Oh,
I'm one who would.
we should plug that on the numbers, Mo. So these numbers we publish every week on New York Stock Exchange's website, ETF Central, and on ETF Think Tank. So we do a weekly roundup of all these statistics. I didn't just rattle them off my head. I'm looking at what our analysts put together for ETF Central and ETF Think Tank earlier this week. So sorry, Mo.
We're 1 and 2. We're on the same level. That was going to be one of my comments, is in relation to the great resource that the team produces. You can find it again, as you said, on ETF Central, as well as ETF Think Tank. And then also from the perspective of the New York Stock Exchange, if you're not already signed up, this is my shameless plug for the day. We do produce a monthly newsletter where we give a broader update of what's happening specifically across the active ETF marketplace, right? Because this is an area where there's just such a high level of growth. You can go to homeofetf.com if you'd like to sign up for that, learn more. Feel free to reach out to obviously anyone on this panel to discuss anything in relation to what we discussed today, particularly that one. Obviously go there. So Matt, I'm going to kind of come to you. You come at this conversation from kind of a different vantage point. One, being closer to what's happening in the capital markets and the trading every day. 2, SPY, right? 30-year anniversary, the first ETF passively managed, but many might not know State Street has more recently launched active ETFs and is in that market. Maybe talk us through what State Street is observing more broadly as well.
Sure, absolutely. As Mo mentioned, we're very much involved in this space as well. At Spider, we launched our first actively managed ETF back in 2012 and currently have 14 active funds in the U.S. marketplace. We've taken a slightly different approach to active management, where 8 of our 14 funds we've actually launched in partnership with some of the best-in-class investment advisors in the world. So we have funds with Blackstone, DoubleLine, Nuveen, and Loomis Sales. You heard the other panelists rattle off some of the very impressive statistics around active and what we've seen this year. I think it's safe to say that active in an ETF wrapper is here to stay, and it's something that we watch very closely at Spider and look for new opportunities day in and day out.
Useful. And Matt, I'm actually going to stay with you as we start to transition away from the broader things that we're hearing. And so as you kind of engage with clients, whether they're end investors, allocators, other issuers, institutions, like what are some of the things that you're hearing across ETF?
Sure. I mean, some of the things that are very topical with our clients right now, obviously tax loss harvesting as we get closer to year end. Take fixed income as an example. Most fixed income exposures are underwater on a 10 to 15 year look back, which has led to a lot of TLH discussions with clients, especially as we're getting ready to close out the year. Another big topic of conversation, which I'm sure Michael is very familiar with as well, is conversions from mutual funds and SMAs to ETFs. More and more, we're seeing our actual clients become sponsors and launch products of their own in the ETF wrapper strategy that they've been managing in-house. Another, very big topic of conversation continues to be ETF price compression. A big part of the market still heavily focuses on the lowest cost provider in any particular asset class. And, we've really paid attention to that and launched a fairly robust ETF low-cost portfolio suite of our own, which I'll discuss a little more, later in this panel.
Useful. So yeah, I think those are very much trends that we're seeing, right? Particularly that trend of end allocators actually wrapping, whether it's an independent RIA or another wealth manager, taking their own proprietary strategies, maybe they're in SMAs historically, and bringing them into the ETF wrapper and taking advantage of the benefits that are there in terms of both access, efficiency, tax, right? So a number of, I think, really good things. Maybe Tony, coming to you, right? You obviously at Morgan Stanley have launched a number of ETFs in a short amount of time. What are the conversations been like with your clients so far, and what are you kind of hearing more broadly?
Yeah, just from what are we hearing from clients? We heard loud and clear over the last 3 to 5 years. We like the customization engine from Parametric. Many are familiar with Custom Core. Parametric manages over $440 billion in assets. We manage well over $200 billion in alternatives from Morgan Stanley, but they wanted choice, and they wanted the ETF wrapper. And so we look at active as our DNA, and then we're expanding choice through the ETF wrapper. We did launch 6 Calvert ETFs on February 1st. We surpassed $400 billion in assets as of the end of September. And so we're making good progress on the ESG front. Just a week and a half ago, we launched 5 active ETFs, 2 from Parametric, 3 from Eaton Vance. Let me quickly highlight Eaton Vance because they're all actively managed. It's Eaton Vance High Yield ETF. We've got deep experience in high yield investing. The Eaton Vance Intermediate Municipal, priced at 29 basis points, ticker EVIM, and also EVSB, Eaton Vance Ultra Short, priced at 17 basis points. So fully transparent active from Eaton Vance. I think the one, though, that was loud and clear is the need for alternative income sources and really helping clients either re-risk or de-risk a portfolio. I mentioned Parametric earlier. In addition to what advisors know about Parametric, they also have an option overlay business that's been in the industry for over 20 years. We manage over 17 billion in option overlay. So we actually put together 2 capabilities: the Parametric Equity Premium Income ETF, ticker PAPI, and the Parametric Hedged Equity. And these are a category that we've seen growing quite fast. In fact, the derivative income category and the options category together are almost 100 billion in assets. We've seen them double in just 2 years. And so we wanted to really meet clients where they are. So what PAPI does, ticker PAPI, it delivers consistent monthly income while maintaining the prospect for capital appreciation. And it does this mode through the combining of 2 capabilities. One capability is a dividend component, which we've been doing for a decade at Parametric. That delivers anywhere from 3.5% to 4% annualized yield, in addition to an option overlay component, which is an additional 4% yield. So we'll target 7% to 8% income, high, stable, and most importantly, and where it's differentiated from competitors, extremely tax efficient income. Many competitors are taxed, the income stream is taxed at pure ordinary income or primarily ordinary income. Our dividend component will deliver a qualified dividend, which is obviously taxed at a more advantageous rate. That is priced at 29 basis points, very tax efficient, much more conservative in structure in that we're using all listed options, which we think is a differentiator, and a great capability from parametric. So at 29 basis points versus the category average at 87, we've gotten good feedback from our clients. We also have, in addition to that parametric ETF, parametric hedged equity, ticker PHEQ, which really, Mo, helps you re-risk or de-risk a portfolio. So essentially, the first parametric ETF is more income. Parametric hedged equity is more focused on downside protection. The one thing I would say is it's less defined outcome. In fact, it's not defined outcome. It's more managed outcome. And what we heard from advisors is they wanted a single ticker solution that really enabled their clients to re-risk or de-risk a portfolio. Again, priced at 29 basis points and extremely competitive to the category. So we're meeting clients where they are, but certainly the alternative income is what we heard loud and clear.
Yeah, that very much is a category, Tony, where we've seen just an immense level of growth, interest. You know, Mike, maybe coming to you, a little bit different perspective, having worked with issuers who are bringing new products to market. I know you've helped a number of issuers, including someone like YieldMax, who has a very unique way of delivering alternative income. But maybe you want to talk about them or others. What are you seeing kind of there from a client perspective?
Yeah, so I love this category, right? Because when Tony introduced his thing in the beginning, he talked about 6C11, and I get asked all the time, what has really helped your business? 6C11 is great. It brought active. 18F4, not to put everybody to sleep with regulations, but that one is the one that really ignited the business at Tidal. Now, 18F4 is known as the derivatives rule, and it basically made it so all kinds of things that historically were in the alternative space, leverage, derivatives use, options use, anything that was more Delta 2, Delta 3 was very, very difficult to do in the ETF wrapper until 2 or 3 years ago. So our chief operating officer, Gavin, likes to say we're in the headache business, right? We take the headache so you don't have to. But what we've seen a ton of is more complex product, right? And YieldMax is a great example of that. We've also done zero DTE call writing. We worked with Jerry Parker, the famous commodities trader, and came out with a portfolio that's trend following on both equities and commodities. That could not have been done 2 or 3 years ago. It still wasn't easy to do. All kinds of way more complex, difficult to put into the ETF wrapper products are where we're seeing the most growth. You mentioned YieldMax. Yeah, YieldMax was that nexus point. Finally, the regulators got okay with some sort of single stock or single security ETF. Everybody went for leverage and inverse. We went for yield. So we have 15 of them now, all the major stocks, that whole Magnificent Seven suite, where you can get exposure to Tesla, Amazon, whichever one you choose. Coinbase is probably my favorite one right now, and have a call strategy on it. So that's a major trend in active, is complex. The other major trend is something that is a bit of a trick question, which is today everybody thinks MAT and SPY is the oldest ETF in the US. There's an ETF from JP Morgan with a earlier inception because it was a mutual fund. So this path of conversion from both SMA, hedge fund, we converted a hedge fund to an ETF this year. And from mutual funds, we're in the middle of a mutual fund conversion for Gotham. I mean, I just don't see it stopping. It's not simple, right? And most of what's been done thus far that's paved the path didn't really work in terms of asset gathering. But it will, right? You converting a loaded mutual fund is a mistake, right? Converting, like DFA has done, non-loaded mutual funds into an ETF wrapper, it's still one time you're guaranteeing tax adjusted better returns for someone. It's literally structural alpha, right? owning owning the S&P in a mutual fund versus owning it as SPY, it's just better for tax investors. We don't get those kinds of guarantees in finance very often. So those are the two big active trends I'm seeing.
Yeah, makes a lot of sense. And we joke, but we say it in somewhat serious, that we're the home of conversions, right? So we've seen, more broadly, I think 65 of these conversions roughly have taken place across about $75 billion in assets raised. And so, but this is something that's only been unlocked in the last few years. We're coming on, I think, the third year, right, of this being an option for a manager. Lots of considerations, Mike, as you kind of share. Obviously, your team can be very, very useful in thinking through those things. I love Gavin's statement of in a headache business, but you really eliminate the headache, which is really, really important. Matt, I want to bring you back into the conversation and kind of continue on this trend of things that we're seeing from a development standpoint, new products. So talked about SPY a little bit. Maybe you want to hit on kind of how SPY has broadly shaped the industry that we now know today. Now we get to argue inception dates, which is a fun one. This is the second time in a week I've heard this line of the JPM being arguably the oldest ETF. But maybe talk a little bit about SPY and then talk about kind of what you see on the horizon.
Yeah, sure. So thanks, Mo. I'd argue that Tony might be better suited to answer this question, given he and Jim Ross ran Spider in the early days and helped build the foundation that helped us get us to where we are today. But all joking aside, as mentioned earlier, our flagship product SPY, or the Spider S&P 500 Trust, celebrated its 30th anniversary in January. Mo and Doug and our good friends at the NYSE hosted us for the closing bell and a fun-filled evening. I don't want this to sound too much like a product pitch, and I think many would agree that SPY is one of the most flexible investment solutions available to investors today. The obvious buy and hold case remains true. That said, we continue to see innovation come from our clients as they discover new use cases for the product, which include using SPY as a liquidity solution. SPY's incredible secondary market trading depth allows for a wide variety of execution strategies. We see clients using SPY as a liquidity sleeve or for the equitization of cash. We see this often with our institutional client base. We see SPY regularly used in related derivative products. SPY is utilized as a reference asset for a significant portion of the retail structured products market. And SPY's options market represented nearly half of all ETF options traded in 2022. And last but certainly not least, we often see SPY used as a hedging solution, from hedge funds to broker-dealer trading desks. We see SPY utilized as a hedging tool in a variety of different ways. I think it's safe to say that SPY has provided a roadmap for products to evolve. Recently, this is most evident in the fixed income market, where ETFs are helping to reshape the credit derivatives market. So, we continue to see more and more use cases for SPY. We're actively involved in ongoing conversations with clients on new ways to leverage and utilize the product.
I think one thing, Mo, if I can add.
Perfect. Yep.
Because I have an affinity for that vehicle. When we talk about times of duress in markets that we've all gone through, whether it was a pandemic, whether it was the credit crisis, whether it was 9/11, when the exchange was closed, everybody looks to SPY and a dozen ETFs for price discovery, and I think that's a really important part of our industry. So
yeah, it is remarkable. I mean, you kind of talked through, Matt, obviously all the derivatives that now reference SPY, right, is a vehicle, but it really has helped define a category that in itself now is, here in the States, roughly $7.5 trillion in assets, right? And it all began with that humble single product that now trades like water, is the joke, but the reality as well. So maybe as we start to last 10 minutes, I'm going to kind of transition to a bit of rapid fire here across the group. So maybe Mike, I'll start with you. You sit in an interesting spot, as we've talked about a few times, and seeing everything come in and seeing all the innovation in this market. maybe two-parter, very fast. What do you see as the single greatest opportunity in our market and the single greatest threat?
Wow. Threat is easy. The threat is the same threat that ETFs were to mutual funds and mutual funds were to annuities, and is a better structure. And everybody assumes that better structure has something to do with tokenization. Lucky for the ETF world, our regulators are very, very slow on this. So the technology could probably be fully ready in the next 3 to 5 years. I think the regulators will probably drag that out to 10 to 12. And just like with the switch from mutual funds to ETFs, many of us will be far ahead of it. I mean, my firm has already invested in a number of tokenization startups and ventures just to make sure we're ahead. And we actually run the largest blockchain ETF. So, the reason I launched that one was I was worried about the ETF industry. So, that's the threat. But I don't know how much of it really means bad things, right? It's just an iteration on structure. Opportunity, it's really just, we're Lindy now, right? The longer we're here, the more likely this is going to survive. And I mean, it's not survive, thrive, right? Because this is just a chassis. It's just a structure, and it's more efficient than the older ones. So as long as you put a good idea into it, you should succeed. Now there will be bad ideas. The open to close ratio right now on ETFs is about 2 to 1, meaning for every 2 opened in the last 12 months, 1 closed. That's good. That's healthy. It's not healthy when a couple months ago, we were up at like 5 to 1. That's too much. And you get some egg on your face when some bad ideas come out or things that are not great for investors. I mean, it's good that the industry has a natural meritocracy to it. I mean, hell, BlackRock closed funds today. I went to trade when I was like, that one's closed. They closed their future trend suite. I couldn't believe it. But that's the health of the industry.
Yeah.
So
no, I think really useful. I love that ETFs are a technology, right? That's how I often kind of describe it. And we're on a constant evolution towards more and more. Obviously, this structure, I always start holding my phone when I think about ETFs, because I think that so much of it is access and what it provides individuals today. And who knows what's next. But maybe Tony, same question for you: opportunity and threat.
Yeah. Look, I'm often asked, like, what's the future look like? Because I've spent a lot of time in the past. Look, whether it's PwC, Cerulli, Brown Brothers, somewhere between 15 and 30 trillion are the estimates. I think Brown Brothers, the peak at the end of the decade at 30 trillion. I believe that number. I do personally. When we look at Europe, there's no doubt what's happening in the US is happening in Europe. And it might, some say 5 to 7 years behind. That's actually getting tighter and tighter. And so I think global ETF growth in Europe and in Asia is accelerating. I know we've been focused primarily on the US. I think that is a significant opportunity. The second significant opportunity, I'm going to play a completely different angle on this, because everybody wants to talk about the next product, and we could talk about product all day. When you look at post Rule 6011 and you look at the traditional active managers who have entered the market, I'm not going to name them, but you know who those firms are. We're one of them. Distribution is key, both in the institutional and the advisor market. In the institutional market, consultants are just coming to know ETFs, and they've been out 30 years, right? In the last 5 years, we're having more dialogue because large global pension plans are actually using ETFs for exposure. So I think that's important. And then in the intermediary market, distribution teams are coming to know ETFs alongside alts, alongside SMA, and certainly mutual funds. So I think that's going to accelerate the growth of the market. In terms of threats, I like the close ratio, Michael. I think that's a good healthy ratio, and I agree with your point. Not everything should be an ETF. And I remind anyone in the industry, there are great exposures that are potentially better in an interval fund or in some other structure. So not everything should be ETF. And my hope is that, we use, prudence and logic as these ETFs get launched.
Yeah, very useful. And, a funny statement coming from myself, who sits at the exchange, is very interested in obviously seeing product continue to grow, but I couldn't agree more. And I think I value in partners like Tidal, Gavin and Mike will often say, the key component of our job, aside from removing headaches, is telling people no, right? Explaining to them the reasons why this doesn't make sense in the wrapper, right? And I think that is important, that we as an industry continue to focus on ensuring that the right things are coming, that we're supporting the ecosystem such that it does truly grow and flourish. Maybe I'll come to you, Matt, for the same question as we kind of come to a conclusion.
Sure. I'll make the opportunity piece easy. I fully agree with Tony. Global expansion, growing the ETF pie globally is a massive opportunity, and one that we're very much focused on. We're going to be investing, a lot of money into APAC and other regions where we see tremendous growth opportunities. As far as, the potential greatest threat, I would call it a threat or potentially an unknown to the ETF industry is the regulatory environment. Equity market structure proposals, the liquidity rule, Basel III, and the subsequent impact to RWA calcs for broker dealers, T+1. All these can and may eventually impact liquidity and cost to end clients. So, it's something that we're all watching very closely. We're all trying to solve for things like T+1 right now. So, it's something that, we're very much involved in speaking up with regulators and stuff like that. So that would be my biggest threat or unknown, as I would call it.
Yeah, I think that's a really good one to bring into the conversation. Obviously, we spotlighted two of the things that very clearly are tailwinds to continued growth of ETFs. They were regulatory focused. There's always the headwind out there of what's kind of next as an industry, helping to kind of shape that and ensure that the right things are happening. So I think maybe to conclude, Matt, how can, whether it's a prospective issuer that's here listening or obviously investors, like what's the best way for them to interact with State Street and Spiders or get in contact with you all?
Sure, we have a quite robust distribution force. So I hope that all the potential clients on this call are speaking to someone on our distribution force. If they're not, please visit ssga.com. You can contact my team directly, the capital markets team, and I can always help put you in touch with whoever you need to talk to. But I think that's a good starting point. Or if Mo and team, they know us very well and can put us in touch. So
excellent, appreciate that. Tony, same question to you.
Same thing. I would just say we've got a distribution force that carries multiple brands, from Eaton Vance to Parametric to Morgan Stanley to Calvert, and we've just launched a new website within the MSIM website. So that's probably the best place to go. I would say we're in the initial stages, Mo, of building this platform out. We're 9 months in. We've launched 11 ETFs, and we certainly have plans globally to continue to expand. Primarily actively managed is where we're focused.
Exceptional. And to you, Mike, last but not least.
Sure. So to find us, we're everywhere. We're all over social media. It's hard not to find us, but I would invite you to visit tidalfg.com. There's a beautiful little button there that says build my ETF, and it'll take you through a questionnaire, and we'll have somebody call you 20 minutes later about whether or not you got a good idea that we can work with. From there, you can also access etfthinktank.com. That's our free website. It's got tools on it. It's got all kinds of wonderful stuff, massive amount of content, videos, everything you could imagine to learn about the ETF industry and sign up for information.
Exceptional. Yeah, and the same is kind of true of us, right? You can find us digitally everywhere, like Mike and team. Don't hesitate to visit. Obviously, ETF Central is another resource in combination with ETF Think Tank to help you kind of navigate that process of looking at all the ETFs and the content, the perspectives across our industry. Then the second is homeofetfs.com, right? That can be a starting point as well, or you can reach out probably to any of us via LinkedIn, send us a message. We're always happy to help. So with that, obviously, thank you to my fellow panelists for joining this conversation, sharing a bit of perspective around some of the things that are happening across our industry. And I'll turn it over to Nicholas to kind of conclude.
Well, my task is very easy. All I have to do is say thank you very much for a great discussion. And thank you very, very much again to all of you.